Hi, everybody. Ed Yardeni here. Well, lots to talk about as always. First, let's talk about uh, our personal lives. Without getting too personal, I hope you've all had a good Easter and are having a good Passover. Spring is here. It's amazing how fast this year is whizzing by, but it is what it is. And meanwhile, the fun never stops in our business. There's always something interesting to think about, talk about, worry about, and get happy about. All the emotionals, ups and downs. It's been a heck of a roller coaster ride. Last year was about, most of the year was going straight down between January 3rd and October 12th. It wasn't straight down, but it certainly felt that way. And since October 12th, we've been back up a little bit here in offsetting the bear market of last year. And the roller coaster ride this year has been kind of interesting. We started out the year, I think, with a consensus that was pretty much convinced that we were going to have a hard landing. And then the January data came out in February, and it was very strong. And suddenly, instead of a hard landing, the perception was that that there might be no landing, that the economy might actually be doing remarkably well. Now where are we? I guess we're sort of somewhere in between hard landing and no landing. I think soft landing is still kind of viewed as a minority view. But I'm not sure what the consensus view is right now. I think the market is trying to sort that out. On the one hand, the economic news is weakening somewhat. We've had the economic surprise index weakening, but then the employment numbers came out and they were still pretty good. And there's plenty of job openings out there. So the labor market still seems to be in pretty good shape. But then there's this nasty little banking crisis that's popped up starting on March 10th, which is when Silicon Valley Bank imploded. But the Fed moved very quickly, and on March 12th, it was a Sunday, the Fed came up with a package of liquidity facility to help the banks. And the question is whether that'll do the trick, whether that'll keep the banking crisis from morphing into a bigger banking crisis, keep it from morphing into a credit crunch and into a recession. I mean, in many ways, it does kind of feel like the same old business cycle where the yield curve inverted last summer, anticipating that there would be a recession. But as I've said many times before, what the yield curve really anticipates is sort of a process, the process being that people are willing to buy bonds at a yield below the 2-year on expectations that if the 2-year stays here or goes higher, that will surely cause something to break in the financial system. And nobody quite knows what's going to break until it breaks. And now it may very well be Silicon Valley Bank that is what's broken. But then we go from that kind of specific financial crisis to much more of a contagion. And right now, people are very worried about commercial real estate. There is an interesting article, I think it was in Bloomberg or maybe in CNBC today, that said, well, we may be getting a recession in the commercial real estate area, particularly in offices, but hotels and warehouses and other commercial facilities still seem to be doing quite well and covering and are able to cover their debt load, whereas there's this fear that a lot of the commercial real estate that's office related is going to have to refinance, and there's going to be a lot of bankruptcies in that area. I think that's very possible, but I would put that in the context of a rolling recession rather than an economy-wide recession. But nonetheless, that is the fear that's out there right now. And we've seen the bond yield come down rather dramatically. Feel pretty good about our forecast back in late October that the 10-year yield peaked on October 24th. That's worked out rather nicely. Can't tell you how low this thing's going to go, though. I think 10-year bonds at 3.5% still look attractive, but they only look attractive. I mean, why are they here if inflation is going to remain here? Clearly, the the 10-year is anticipating that the financial crisis, the banking crisis, will become a credit crunch, will become a recession, and that the Fed will have to lower interest rates. And I mean, it's a perfectly workable scenario, because what happens in a recession is you bring inflation down and you bring interest rates down. And one of the problems for the banks right now is that interest rates are too high, so they're facing disintermediation. Money is coming out of their deposits, and in order to compete with the money markets, they have to raise their interest rates on deposits, and that's pressuring their profitability. This is obviously a big week for the banks. We'll see how the big banks interpret all this. Jamie Dimon's already been out there with his letter to shareholders saying that this could take a while. There could be repercussions. I think what he knows, that I think the rest of us know as well, is that the commercial real estate's in trouble, and maybe he's seeing that. I mean, he's not telling us anything new about the mortgage market. We know the mortgage market has been depressed, but again, it's been a rolling recession. The single family housing has been in a recession, but the multifamily is still doing extremely well. And then, of course, there was those purchasing managers indexes that looked weak. I've been pointing out for a while that the MPMI, the manufacturing, makes sense because people have pivoted away from buying goods to buying services. What doesn't really make sense is the weakness we've seen in the services PMI, the NM, non-manufacturing PMI, especially given that the S&P Global Flash estimate actually went up for services. So I'm a little bit skeptical that people have suddenly decided that they don't want to go out to restaurants, they don't want to go to recreational activities, and they don't want to go out flying and traveling about. I can't see what's suddenly changed there. And so let's go look at some of the charts that are relevant to this stream of consciousness that I've just shared with you. And let's go to the videotape here. We'll share this. I just want to bring to your attention, which we highlighted in the morning briefing, that we scrambled to put together something called U.S. Money and Credit Commercial Bank Book. We've had a chart book on commercial banks posted on the website for quite some time, but the banking crisis really focused us on redoing it, and so we can all together hold hands and monitor this crisis. It's going to be a weekly situation, week by week, unless something blows up along the way. That's always possible, but I think the week-to-week indicators will be what we know we're going to be able to watch. We have this H8 release that the Fed comes out with, and they come out with it on Fridays at 4:15, and that shows the assets and liabilities of the commercial banks. The day before at 4:15 on Thursdays, there's something called the H.4.1, H41 release, and that looks at the Fed's balance sheet. And so we can get a closer look at the Fed's discount rate window. We can get a better look at the bank liquidity facility to see what's going on. So it's on the website. I'll show you right here. This is Global Money and Credit, U.S. Money and Credit, and then you can see commercial banks, which is what we're looking at now. So to take a look at that on your own, I think you'll find it a useful way to sort of understand the interactions of the assets and liabilities in this banking crisis. This shows you total deposits of the banks. It shows you on a ratio scale. It's kind of interesting how you can kind of change a picture just with a ratio scale. If you really want to worry, this, I think I've got it here somewhere. Maybe I shouldn't have promised it, but it's here. Well, I'm sure we'll run into it along the way, but when you take a ratio scale, it doesn't look all that terrible. When you take a regular arithmetic scale, this looks like it's going straight down. So this is commercial bank deposits. As you can see, they have been kind of coming down. That's sort of disintermediation. It's also QT, quantitative tightening, has had an impact here on this as well. But I guess this is something to worry about. Looks like there's a bigger drop here for small banks. This is the actual level of it. And then there's borrowings. This is a level, not a rate of change. And it shows that total bank borrowings jumped up. And a good part of that is probably SVB. SVB had $200 billion in assets and liabilities, basically. And if a good chunk of those deposits left electronically, I was going to say overnight. It's not overnight anymore. It's in a nanosecond. Then they would have had to go and get the liquidity from the Fed, and you can see that that's what's happened over here. And we show the small banks and the large banks. This is securities. Now this looks somewhat worrisome to see that they're being forced to reduce their securities, but I think that kind of reminiscent of what happened with SVB, that they had to scramble to sell securities at a loss in order to offset the deposit outflows the bank run until they imploded, because it's not a sustainable situation. And again, this looks somewhat worrisome, but keep in mind that there's a likelihood that most of these securities that are falling in terms of the outstanding amounts may very well be maturing securities that simply are not being rolled over. And that's my hunch. And that's being used to produce some liquidity for the banks internally without having to go to the discount window and so on. This is government securities. Again, the banks, I've said this before to you, that I've been doing this for a while, and I've concluded that you just don't really get a situation where supply and demand analysis works terribly well for understanding the bond market. You can see that if the commercial banks are now, let's optimistically say they're letting things mature, but they're not rolling them over, then why isn't the bond yield going up? Instead, it's going down. Well, because I think the bond market's mostly driven by inflation expectations, and expectations of what the Fed will do about all that. This is other securities. This is loans and leases. This is where we're going to be watching out for the credit crunch. And this is through March 29th. So we got basically 3 weeks of data since the beginning of the banking crisis with the implosion of SVB on March 10th. And the loans are still going up. Or maybe if you take a magnifying glass, they're going sideways. But in recessions, they typically, as you can see, this is a ratio scale. So they do stop going up and they start coming down some. This is loans and leases at all banks. You can look at that on your own. This is an interesting one. This is where everybody's focusing. This is commercial banks, loans and leases, small banks. And you can see that this green line is commercial real estate. And so they've got $2 trillion of commercial real estate loans on their books. You look at the big banks, and here's commercial real estate, is $0.8 trillion. So the big worry is that there's going to be there is already a credit crunch in the regional and community banks, and they're not going to be able to refinance maturing commercial real estate loans. And at the same time, at whatever rate they charge, the people who have to refinance their mortgages for office buildings are not going to be able to make ends meet, and will have to sell the properties at a loss or just declare bankruptcy. So that's the issue, and I don't want to minimize it. It's a real issue, but at this point, I kind of view it more as another sector that's rolling over while some other sectors remain strong. We'll see what the big bank executives have to say about their allowances for losses. Given the way Jamie Dimon's been talking, you'd think that the JP Morgan is going to be setting aside a lot of money for allowances for losses. But all the banks did some of that during the fourth quarter. Let's see if they do some of that or more of that in the first quarter. We have weekly data that the Fed publishes as part of this assets and liabilities sheet, Excel sheet. And you can see that there isn't, I mean, it's been going up, but it's not like going straight up. And this is through March 29th. So you would think that they'd be scrambling. Maybe they haven't had their committee meetings, and maybe they're having them now just before the discussions. But I mean, they are going to be talking about first quarter results, and first quarter results shouldn't be weighed that much down by allowances for losses. It's kind of a tough balancing act for the bankers. On the one hand, they don't want to get too alarmist by increasing the loan losses, especially if they're not seeing major loan loss problems. They don't want to do that and get investors all upset. On the other hand, they want to convince regulators, yes, we know there's problems out there. We've been stress tested. We're ready for it, and we're going to do something about it. We're going to put more money away and act responsibly. So we'll see how that plays out this week. That'll be kind of interesting. I'll go a little bit faster here. You can look at it on your own. At the very end is a good way to watch everything on a weekly basis. So this is the week over week change in the assets and liabilities of all banks. So here's bank credit, which is down. So there's looks kind of crunchy, right? Credit crunchy. Securities are down. And again, is that this being forced to sell at a loss, or is it just maturing securities and a decision not to roll them over into new maturities, but to keep it as liquidity for making loan demand or offsetting any weakness in deposits. So this is loans and leases, which is again part of bank credit, and that's been weakening here. And then deposits is where you've seen some outflows here, though they seem to be slowing, but it's only 1 week. But then I'm an optimist, so 1 week's good enough for me, but may not be enough for some of you folks out there. And then there's borrowings, which spiked up here during the SVB commotion and has settled down since then. Let's go to the see if I can. Yeah, let's go to the morning briefing. And the morning briefing has a lot of those charts at the end, so we're not going to go over them. But let me just go over the roller coaster ride. As you can see, we started out the year with the Citigroup Economic Surprise Index on the downside weak, and so there was a lot of talk about a hard landing. And then we got the January indicators in February. This thing shot up, and suddenly everybody's talking about no landing. Remember, we've been talking about soft versus hard landing for about a year, and taking the position that soft landing 60% probability and hard landing 40% probability. We weren't talking about no landings, and even we started saying, well, we might have overlooked that as a possibility. And I put that in the framework of soft versus hard. I mean, we could have a no landing that's inflationary or a no landing that's disinflationary, but let's not go there now. We've covered that territory before. So here now you're seeing some downward surprises, and so that's weakened some. And then again, the employment numbers were pretty good on Friday. And what else do we know? We know that there was some revisions in February's numbers to the upside, but that's been a bit of a roller coaster. But it's not as though this thing isn't usually a roller coaster ride. And there's been a heck of a roller coaster in the bond market. We saw the 2-year and the 10-year yield going up on the perception that the economy might not be landing after all, and therefore it might be harder to bring inflation down. And then suddenly everything shifts around to, well, maybe especially because of the banking crisis, we're going to have a credit crunch and a recession after all. The FFR futures, the Fed funds rate futures, again, quite a ride there. Meanwhile, when you look at the economic indicators that have come out, I think the bond market actually rallied on the job openings data because it was down, but that doesn't look to me as though we've got a shortage of jobs. Maybe they're extrapolating that this thing's going to go straight down. Banking crisis, credit crunch, recession, people lose their jobs and it just goes straight down. Look, baby boomers are still going out to restaurants and they're still going traveling. So, and they're going to the hospitals and the doctors just to make sure that they're fit to do all that. And so the demand for healthcare workers, for restaurant workers continues to boom. Where we are seeing some weakness is in technology employment, obviously, maybe some in financials. But look at initial unemployment claims. I know they were revised, but we're still talking about low, 200,000, close to 200,000, which is very low. And again, we've got 1.7 open job openings per unemployed person out there. This is a recent favorite chart of ours, so looking at the three ways to track the job openings, and the job openings that come with jolts is old data. It's February. The jobs plentiful is March. The small, that comes from the conference board, and then there's a small business with job openings, and that's March. And all in all, yeah, they've peaked, but they're still at historical highs. And in order to believe that, if you believe a recession is coming because of a credit crunch, and these are going to go straight down, and this will all have turned out in some ways to been all sort of like the impact and the initial impact of the pandemic and all the shock waves that have occurred since then. Meanwhile, this looks pretty good. You got the household employment measure, which is measures the number of people with jobs. The payrolls measures the number of jobs that people have. So one person with two part-time jobs counts as two jobs. In the household survey, one person with two jobs counts as one person. So this is the number of people with jobs, and it's at an all-time record high. It looks like it did actually get stronger in March, so that's an encouraging sign. It suggests that the economy is doing so well and the labor market so tight that people who might have only been able to get part-time work are now being offered full-time work, and they're taking it. I am seeing some indications that we're sort of going back to an old normal labor market. We'll look at a few more like signs of that. This is aggregate hours worked in manufacturing, and you can see it's been kind of flat, going up and down. And so that suggests that consistent with soft landing, that we're not seeing a plunge here in industrial production, but what we are seeing is maybe a sideways move in industrial production. Again, we're talking about the economy, just trying to assess where we are right now. And when the labor market, when the employment numbers come out, not only are we able to glean what industrial production data will show later in the month, which we now expect will be flat to down a bit, we can also get a good handle on personal income, which a lot of it is wages and salaries. And we calculate our earned income proxy based on the number of people that are working payrolls, the number of hours they work, so aggregate hours, billions of hours worked per month, and then wages. So you put that all together and you get this earned income proxy. And you'll notice here that the earned income proxy is kind of flattened out here, and it's because the payrolls were strong, the wage increase was okay, 0.3, but the hours, the average hours worked, average weekly hours took a dive. But let's put this into context. One, it's a volatile series. Two, maybe what's happening here is, the pandemic caused this a lot of people to have to work longer hours because a lot of people stayed home. So those who stayed at work had to work longer hours. And now we're just kind of getting back to a normal situation here where people don't have to work longer hours because there's enough people kind of covering different positions in the company that's what's really changed. So that's kind of getting back to normal, as I just mentioned. A lot of this was kind of in the morning briefing was building up to the thinking about the index of coincident economic indicators. It's basically my go-to monthly indicator of real GDP. There's a very strong correlation between the index of coincident economic indicators and real GDP. And in March, which is the next data point, it may very well go flat. It could maybe inch up to another record high, but it was at a record high in February, and it could go down a little bit. But this I don't think we're about to see something like this, but I could be wrong, and I'll be watching it and assessing it for you as you will be as well. We don't have to do this. We already just ran through all these charts of the commercial banks and then some. So, we've promised you that we'll always try to do our best to stay on top of the issues that matter most. And we've been doing that on inflation. We've been doing that on hard versus soft landing. And now we're doing it on the banking crisis. Will it morph into a credit crunch and a recession? We don't think so, but we're very data dependent, as the Fed likes to say, and we're going to be watching it. As for the Fed, I think they should just give it a rest. I just think it would be a mistake for them to keep raising rates when we've got stress here in the banking system. Let me stop sharing and let me start caring about your questions here. Walter, happy Easter and to you and the team. Thanks for your compelling work. Well, thank you, Walter. Appreciate that. Benton, please comment on how the Fed distorted the risk-reward functioning of the market. It seems we are permanently in crisis mode, one crisis to another, with the U.S. Fed rescuing any and all. This will end disastrously at some point. How long do you think we have? 5 years, 20 years? Great question. If you got a few hours, we can discuss it. But the short and long of it is, the Fed has been sort of, it's been sort of a drug dealer. It's been providing free drugs, free money for a long time. I think Fed officials and other central bankers, for some reason, got really spooked by the great financial crisis and decided that if they weren't going to provide enough liquidity, we'd have deflation. They were paranoid about deflation. The history of deflation is it isn't always bad. Sometimes deflation associated with job gains is a sign of productivity and real income growth. Anyways, the central bankers had this fear of deflation, kept interest rates at zero or below zero, negative interest rates for way too long, and everybody got used to free money. And then all of a sudden, inflation came back. I don't think it was just because of monetary policy. I think it was a combination of excessively stimulative fiscal policy and monetary policy accommodating that. And as a result, that caused inflation to rise rather quickly. And then the central bankers realized that they were behind the inflation curve and started to tighten. Look, in terms of, we have sinned and we have to pay a price for that. That's kind of the moralistic, pessimistic approach to thinking about these markets. It also puts a tremendous amount of focus on the central banks, and they deserve a lot of focus, both especially a lot of blame for what's been happening here, and also in terms of going crisis to crisis. But there's lots of other things going on in our economy that account for its strength. I've always said it's amazing how well we do in our economy, despite Washington, despite the Fed, despite the Treasury, despite the politicians. So I remain optimistic that we'll get through all this, and we'll have the economy expanding at a better pace. We'll have a technology revolution continuing. We might even call it the roaring 2020s once we look back on it at the end of the decade. But you said, will it take 5 to 20 years? I'm seeing a lot of people worrying that it could happen like in the next few weeks, that we'll come to a dead end on this whole thing. And the big fear, of course, is what's going on in the banking system. A lot of what happens to the banking system is dependent on trust. It doesn't do very well on fear. Jamie Dimon said, it's not in the big banks' interest to have problems with small and medium banks, because trust is trust. If you don't trust your regional bank, it kind of trickles up to not trusting your money center bank. So I think some of these concerns about this coming to a head are certainly being fanned by pessimists who say, see, we told you so, something always breaks. I thought that the inverted yield curve could lead to something breaking. But the question is whether it causes a credit crunch. And I've been arguing that the banks are actually in pretty good shape. Certainly the big banks are. And now what are we going to do with the small mid-sized banks? I think there's going to be a lot of M&A activity, which straightens that out. So somehow or other, we're pretty clever at getting through these crises. moving on to better times, then setting ourselves up for the next crisis. And a lot of bubbles have blown up here. The SPACs, the ARC stocks, the meme stocks. I'd say the bond market, to a large extent, was a bubble. That's blown up. And yet look at these employment numbers and that the economy is actually still growing. I'll take one more question. Doug, what do you think the level of long-term potential real GDP is? Will GPT and its lookalikes be able to create a roaring 20s boom? And what will stop deposits from continuing to flow from regional banks to this systematically important financial institution? And what will that do to small business? Well, all the more reason to watch the deposit data. I think that one way or the other, these small banks and large banks are going to have to pay more on their deposits in order to keep them. And when that happens, that's going to squeeze their profitability and induce a lot of them to consolidate. So I think you're going to see a big M&A move here in the banks, and that might actually be viewed as bullish. If it turns out that there is a solution to the deposit issue with small and mid-sized banks, and it's resolved through mergers and acquisitions, I think the markets will greet that well, and the market will certainly be looking at, okay, which community or regional bank should I be buying here as a possible takeover candidate? It's happened before. It happened. We got through the S&L crisis, restructuring thousands of them. And I think we're going to wind up doing something similar to that this time around. Yeah, I'm still in the roaring 2020s camp, and maybe even more so now with all the hype about artificial intelligence. I've been working this morning on writing my morning briefing, and I have to confess to you that I'm using GPT. I think I'm using 4. I think actually I'm using all of them. I'm using Bing because the open AI is only through 2021, and I want to make sure that I'm current when I ask HAL 9000 some questions here. And so I asked HAL 9000, a computer from 2001: A Space Odyssey. I asked, when did Powell start using the word transitory? And it got me right there. And I said, okay, when did he say it's time to bury the word transitory? And it took me right there. I could have found it myself, but this was like a speed of light. So it's helping my productivity, I'll tell you that. One more, Tim. Banks under 250 billion in assets will most likely see more regulation now, with the incentive, less regulation, to stay under 250 billion possibly gone now. Do you foresee more bank mergers? Yeah, I just answered that question. And that's a good way to put it, is that there's less incentive to stay small. Let me see if I missed anybody else here. Yeah, Bing. Still on the year-over-year basis, bank deposit outflows seem to be accelerating, making new lows, going further back to at least 1970. The concern is that funding markets lead credit markets, which lead equity markets. What is your take? I mean, it's a relevant and realistic concern that you're laying out here. I guess I'm more looking at this kind of week by week in terms of the deposit numbers, but I'm looking at the assets and liabilities on a week-to-week basis. So based on that, all I can say is it's not looking great. It's not looking terrible. We'll see. We'll play week by week, and of course, while we're doing that, something could make the headlines. But as I said, I see a way out, which is the Fed provided liquidity facility for the banks to borrow money if they have deposit runs. So that might very well reduce the likelihood of deposit runs. And the banks are going to have to increase their deposit rates to keep deposits, and that will lead to M&A activity. So that's a relatively upbeat way to look at things, I think. I think that some of you like our work because we try to be balanced and more often than not have an optimistic conclusion on things. But thanks for tuning in. We really appreciate your interest in our work, and have a good week.